Welcome back to the Deep Dive. Our mission, as always, is to get under the hood of the world's biggest companies to understand the forces that really shape our markets and, the stories behind these giants.
And today we have a big one.
A very big one. We are deep diving into the Charles Schwab Corporation. And this is a name that's, it's just synonymous with personal investing for millions of people. But its history is, let's just say it's way more turbulent and revealing than that friendly branding might suggest.
It really is, and this is such a crucial deep dive for anyone who invests today, period. Because Schwab isn't just, another brokerage. It's the company that fundamentally rewrote the rules for Wall Street.
Right.
They proved that investing could be cheap, that it could be accessible, and that it could be automated. But their journey, from this tiny startup challenging the establishment to, becoming the establishment, it's just filled with these huge acquisitions, dramatic leadership battles, and some pretty significant regulatory challenges that honestly, they reveal exactly how the modern financial system works.
That is the perfect way to frame it. We're talking about a financial giant that is scaled to a level that is, frankly, just astonishing. To give you, the listener, a sense of that immediate scale, as of 2024, Schwab manages $10.1 trillion in client assets.
10.1 trillion.
Trillion. That's the size of many national economies. And they're servicing 36.5 million active brokerage accounts.
And that kind of scale, it just gives Schwab this enormous systemic influence. It means a huge percentage of American household wealth is flowing right through their platforms. And we have some amazing source material that details every single phase of the story. The tech leaps, the big acquisitions, the leadership changes, and I think most importantly for an informed investor, the controversies around transparency and fees.
So our mission today is to trace that incredible arc, how a small investment newsletter became this titan that pioneered discount brokerage, then swallowed rivals like TD Ameritrade, and how even the most consumer-focused pioneer has to grapple with the realities of making a profit in a world that's supposedly commission-free.
Let's do it.
All right, let's start at the very beginning. Section 1. The Founding Revolution from 1963 to 1982.
It's funny, the foundational story is so often lost in the massive corporate machine they are today. Charles R. Schwab, he didn't start as a Wall Street executive. He started as a publisher.
A publisher of accessible investment knowledge, which is so key to their identity. In 1963, he launched Investment Indicator. It was an investment newsletter.
Right. And at its peak, the newsletter had about 3,000 subscribers, and they were each paying, $84 a year.
That's it. And that small price right there, it established that early value proposition, giving you essential market knowledge for way cheaper than the established gatekeepers were charging.
And that whole emphasis on direct communication, on empowering the individual, that really paved the way for the company itself. So the firm gets incorporated in 1971, but it was initially called First Commander Corporation.
A very different name.
Very different. But the vision quickly narrowed to Charles Schwab's own. He bought out his partners, and by 1973, it was officially Charles Schwab & Co. Inc. The stage was set.
And the disruption that came next wasn't really enabled by some brilliant new technology, not at first anyway. It was a key regulatory shift happening in Washington. And this is the moment that just redefines their entire future. The birth of discount brokerage.
It all comes down to a date that people in finance call May Day, May 1st, 1975.
May Day.
Yep, this was the day the U.S. Securities and Exchange Commission, the SEC, mandated the deregulation of commission rates. See, before 1975, commissions for buying and selling stocks were fixed. They were standardized, and they were notoriously high.
Which made Wall Street basically inaccessible for your average middle-class investor, right?
Right. It was essentially a cartel system. It guaranteed huge revenues for these full-service brokers, no matter what the quality of their service was. But as soon as that fixed system was gone, Schwab was just ready. They were ready to bounce.
And they did. They immediately set up a stock brokerage and opened their first discount branch in Sacramento, California in September of '75.
And you have to understand the difference in the model. The full-service firms, they relied on those big fixed commissions to pay for their expensive research departments, their tailored advice, the whole white glove overhead.
Right.
Schwab just offered execution. That's it. They focused on volume and price. They were, in effect, separating the advice from the actual transaction.
And the market just ate it up. The growth numbers we see in the sources are, it's just staggering. By 1978, Schwab had 45,000 client accounts.
And then a year later, in 79, it doubles to 84,000.
And by 1982, it explodes to 374,000 accounts. They just tapped into this massive, completely underserved retail market that was desperate for access.
But that kind of scale, you just can't handle that with old school methods.
Yeah.
And this is where Schwab's true genius, or, maybe massive gamble, comes into play. They bet aggressively on very early technology.
This is the beta system.
This is the beta system.
Yeah.
In 1979, Schwab risked an incredible $500,000 on a proprietary back-office settlement system called beta. It stood for brokerage execution and transaction analysis.
$500,000 for a company of that size back then? I mean, that was a huge, huge gamble on an in-house tech system. Can you walk us through what beta let them do that their big traditional competitors just couldn't?
That $500,000, that was the money that built Schwab's competitive moat. The traditional firms, they were still relying on slow, expensive, and just error-prone manual clearing processes. A trade might take days to fully clear.
So you're talking handwritten tickets, physical checks.
All of it. And a huge staff just dedicated to fixing mistakes. Beta just automated that entire process.
So it wasn't just about placing the trade. It was about the aftermath, the settlement, the accounting, the record keeping, all done with machine speed and accuracy.
Precisely. Beta made Schwab the first discount broker to bring that critical back-office automation in-house. And that efficiency meant they could process thousands more trades a day than their competitors, and at a fraction of the cost. It was the only way to make the low-commission, high-volume model work.
Without beta, the whole idea just collapses.
It dies on the vine, absolutely.
And that technological lead, it translated directly into these groundbreaking services that really prioritized the customer. In 1980, they set up the industry's first 24-hour quotation service. Before that, when the markets closed, you were just cut off.
And they kept pushing. By 1982, they were the first firm to offer 24/7 order entry and quote service. Just think about the psychological impact of that for an individual investor. You didn't have to wait for your broker's office to open.
You could act on something happening in the market at 10 o'clock at night.
Exactly. It completely redefined the relationship between the investor and their broker. It was anticipating the always-on nature of the internet era decades early.
And that spirit, it went beyond U.S. borders pretty quickly.
Right.
They set up their first international office in Hong Kong in 1982, clearly going after expatriates and global investors. This whole era, it just established Schwab not just as a cheaper option, but as the technology and convenience leader, period. So Schwab is riding this incredible wave of tech and disruption, but success, especially in finance, it often brings these really complicated corporate maneuvers. And that brings us to section 2. The corporate roller coaster from 1983 to 2007.
Right. This is the period of ownership changes, this push for vertical integration, and some pretty high-stakes legal issues that defined them in the 80s and 90s. And it starts with the surprising Bank of America chapter.
It is surprising.
This whole period just shows the explosive creation of value Schwab had achieved. In 1983, Bank of America buys Charles Schwab for, a pretty significant $55 million.
Which at the time was a lot of money, but in hindsight, a bargain.
A bargain. For BOFA, it was a move to integrate this fast-growing retail business.
But that marriage was really short-lived. It just reflected this fundamental clash, didn't it, between a massive traditional bank culture and this disruptive upstart that Schwab represented. And Charles R. Schwab, he pretty quickly decided he wanted his company back.
He did. Only 4 years later, in 1987, he leads a management buyout. They purchased the company back from Bank of America. And here is the just staggering data point. The repurchase price was $280 million.
Wow. From $55 million to $280.
A more than five-fold increase in the company's valuation in just 4 years. It was a high-stakes corporate reversal.
A five-fold increase in 4 years. That has to be one of the quickest and most expensive, oops, I made a mistake, moments in corporate history for Bank of America. What was driving that? Why the sudden urgent need to buy it back?
The sources are pretty clear on this. It was driven almost entirely by the sudden, maybe unforeseen profitability of one specific product, Schwab's no-charge mutual funds.
The mutual fund supermarket.
Exactly. In 1984, they launched 140 of these no-load mutual funds. This created a model where investors could buy funds from all these different companies in one place without paying the typical sales loads or high commissions.
So Schwab isn't making money on the commission for the trade, but they're taking a fee, a kind of revenue share from the fund companies themselves for bringing them customers.
Precisely. And Bank of America, they likely just didn't understand the immense cash flow this new model was generating. It probably prompted Schwab to urgently reclaim the company before BofA fully realized the gold mine they were sitting on.
That repurchase really cemented their independence, and it let them continue down this path of strategic vertical integration. A key move here was in 1991, acquiring Mayer and Schweitzer, a market-making firm.
Yeah, and market making is a technical concept, but it's so crucial to understanding how modern brokerages make money. We should probably break it down.
Let's do it. What did this acquisition let Schwab do that they couldn't before?
It was the next logical step to control the entire trading process. A market maker, basically, they stand ready to buy or sell a stock to make sure there's liquidity. By buying their own market maker, which they later renamed Schwab, Capital Markets Schwab could execute customer orders internally.
Instead of sending them out to an exchange or some third party.
Right. And by internalizing that order flow, they essentially cut out the middleman. They could capture the tiny difference between the highest price a buyer would pay, the bid, and the lowest price a seller would accept, the ask. That difference is called the spread.
And capturing the spread meant Schwab now had this powerful new revenue stream. It wasn't just commissions or mutual fund fees anymore.
Exactly. This vertical integration, it boosted efficiency, but, and this is critical, it also introduced a new regulatory responsibility. The duty to make sure customers were still getting the best available price.
And with that new responsibility came immediate regulatory scrutiny. There was that $200,000 fine they got in 1997 for failing to arrange the best trades for customers.
That fine, while it's small in dollar terms, it's a huge early warning sign. It highlights the risk that's just inherent in vertical integration. When the brokerage taking the trade and the market maker providing the execution are the same company.
There's a conflict of interest.
A massive one. Regulators have to be really vigilant to make sure the company's internal profit motive doesn't override its obligation to the client.
And while they're wrestling with all these integration issues, their digital transformation just kept accelerating. In 1996, they launched web trading, moving transactions from that 247 phone line to the very nascent internet.
It was a natural evolution from beta, really. The internet offered the same core benefits, automation, and scale, but now it was directly in the hands of the consumer, 24/7, without even a phone call. It just dramatically increased convenience while lowering Schwab's internal costs even further.
And they were recognized for it, right? Their commitment to user experience, I think a redesign of their website ended up in the Cooper Hewitt Museum's National Design Triennial in 2006.
It did, which shows they were thinking about user interface way ahead of a lot of other financial firms.
Okay, so now we have to turn to the infamous U.S. Trust saga. This was a high-stakes play for the ultra-rich market that went sour almost immediately.
Right. So Schwab buys U.S. Trust in the year 2000 for $2.73 billion. And the strategy, on paper, it looked sound. Use this acquisition to move beyond their mass market retail identity and compete with these elite wealth management firms that catered to multimillionaires.
But the integration was a complete mess. Less than a year after the deal closed, U.S. Trust gets hit with this massive $10 million fine for violating bank secrecy laws.
And that fine signaled systemic compliance failures. It was likely about things like money laundering controls or failing to properly report large or suspicious transactions. When a bank gets fined for bank secrecy laws, it signals deep structural problems with their oversight.
And for a brand like Schwab, who's built on trust and transparency for the little guy, acquiring a firm with such obvious regulatory flaws was just toxic.
Absolutely. So after 6 years of these operational and regulatory headaches, Schwab finally announced they were selling U.S. Trust back to Bank of America, of all places, in 2006.
And they closed that deal in 2007.
What's interesting is they actually sold it for $3.3 billion in cash. So they netted a profit of, about $570 million?
So financially, it looked like a win on paper.
On paper, yes. But the strategic cost was enormous. The years they spent cleaning up that regulatory mess, the distraction, the reputational risk, it all proved that just diversifying into these complex, high-net-worth markets through acquisition was a huge danger if the underlying culture wasn't sound. It showed the limits of just growing through financial might alone.
That corporate roller coaster, you've got the dot-com bust, the U.S. Trust debacle, broader market challenges, it all created a pretty significant internal crisis. And this brings us to Section 3, where the company it momentarily lost its way, requiring the dramatic return of the founder. Let's talk about the short-lived leadership of David S. Pottruck.
Pottruck was really the heir apparent. He'd worked with Charles R. Schwab for 2 decades. He shared the CEO title from '98 to 2003 and then took sole control in May 2003. This should have been a really smooth generational transfer of power.
But instead, it ended with a swift and pretty abrupt firing. Pottruck was ousted in July of 2004, and this was precipitated by a really significant financial decline, right?
It was. The firm had just announced a 10% drop in overall profit and specifically noted a staggering 26% decline in revenue from customer stock trading.
And that decline was directly tied to a major strategic mistake: fee hikes.
That's it. Pottruck's strategy was to try and maximize revenue from their existing clients, and it just fundamentally betrayed the low-cost discount model that Schwab was built on. It was a classic case of the disruptor trying to act like the expensive establishment it had disrupted. And clients, well, they voted with their assets.
That's such a profound point. The market was literally punishing Schwab for abandoning its core mission. But Charles R. Schwab was ready to step back in for his second act.
And his return was a philosophical course correction. It wasn't just a management change. He was blunt about it. He said the company had lost touch with our heritage. And the moves that followed were swift and decisive.
He immediately refocused the business on providing accessible financial advice to individual investors.
Reaffirming the value proposition.
And, crucially, he rolled back all of Pottruck's unpopular fee hikes.
And the effects were immediate and profound. Lowering those fees sent this undeniable signal that Schwab was returning to its core identity as the champion of the retail investor. The results, they speak for themselves. Earnings rebounded right away in 2005. The share price surged 151% between Pottruck's firing and 2008.
And even more telling than the stock price is the flow of money. Net transfer assets, so the money coming into Schwab from competitor firms, it quadrupled between 2004 and 2008. Investors basically demonstrated their loyalty to the idea of Schwab as long as the company upheld its end of the bargain on low costs.
This turnaround just proved the strength of that founding philosophy. It was a powerful lesson in brand integrity. In finance, trust and identity are assets you can destroy very quickly if you start chasing short-term profits with fee increases.
And following this period of recovery, the company made a critical leadership transition to ensure some stability. Walter W. Bettinger.
Right. Bettinger had joined Schwab after they acquired his company back in 1995. He'd served as COO. And he took over as CEO in July 2008. And that timing was strategic. It was right on the cusp of the 2008 financial crisis.
Navigating that crisis and the decade that followed would require a really steady hand. And Bettinger proved to be that long-term stabilizing force. He guided the company for 16 years, all the way until his retirement in 2024. And all the while, Charles R. Schwab remained the philosophical anchor as the very active chairman.
We now move into the era where Schwab really cemented its dominance. It's the transition from disruptor to the ultimate consolidator, and this period is just defined by massive strategic moves. But first, let's just briefly touch on the exchange listing shuffle.
Right, because this gives some insight into the strategic perception of financial identity. In 2005, Schwab moved from a dual listing to exclusively listing on the NASDAQ. They even changed their ticker from SCH to SCHW. Why did they do that?
The NASDAQ exchange, back then, it had this really strong association with high-growth, technology-forward companies. And Schwab's identity was so linked to its tech pioneering, beta web trading. So the 2005 move was likely a symbolic effort to reinforce that identity, to kind of distance themselves from the more traditional old guard image of the New York Stock Exchange.
But then, just 5 years later, in 2010, they switched back to the NYSE. Why the return trip?
By 2010, after the financial crisis and their period of stabilization, Schwab wasn't just a disruptor anymore. They were a massive, systemically important financial institution. The NYSE carries this perception of stability, maturity, traditional financial heft. So the returns signaled that they were now a part of the establishment, which was probably reassuring to investors after the turbulence of 2008.
And regardless of where they were listed, the focus from 2011 to 2020 was on these very targeted acquisitions, all designed to build a complete wealth ecosystem around their core brokerage service.
That diversification was crucial. In 2011, they bought Options Express, which strengthened their services for more sophisticated active traders. Same year, they bought Compliance 11, a software provider.
And buying a compliance software company might seem like a small detail, but if you connect it back to that U.S. trust fiasco we talked about,
Oh, absolutely.
the insight is clear. Schwab learned the hard way that your regulatory infrastructure has to be vertically integrated and highly controlled. They got burned by previous compliance failures.
It was a direct investment in their regulatory moat, and they kept diversifying. They bought Thomas Partners in 2012 for asset management, then Wasmer, Schroeder and Company, a fixed income firm, in 2020. They were building a complete menu for any type of investor.
And this expansion was also about just sheer client numbers. The acquisition of USAA's investment accounts in May 2020 for $1.8 billion in cash was a huge move.
It instantly brought in this massive, high-quality, and deeply loyal client base of military members and their families. It just consolidated their retail dominance and gave them huge cross-selling opportunities.
And amidst all these massive corporate moves, there was a simple little innovation in June of 2020 that really reinforced Schwab's founding identity, Schwab stock slices.
Right, stock slices. It allowed investors to buy fractional shares, and this is so important for democratization. For a really expensive stock, a small investor might have had to save up thousands just to buy one share.
Fractional shares just lowered that barrier to entry completely. It let people invest small amounts regularly and diversify easily, staying true to that original mission.
Absolutely.
But the defining move of this whole era, the one that permanently reshaped the brokerage landscape, was the TD Ameritrade mega acquisition. This was consolidation on a scale we had not seen.
The deal, announced in late 2020, was just colossal. TD Ameritrade was one of the last major direct competitors in the discount brokerage space. Buying them eliminated a chief rival, integrated millions of clients, and crucially, brought in one of the industry's most respected trading platforms, thinkorswim.
Let's talk about the magnitude of that. Merging two giant, complex companies like that is notoriously difficult. What was the core value Schwab was getting, and what were the immediate ramifications?
The value was really twofold: scale and technology. TD Ameritrade added about 12 million active accounts and trillions in client assets, pushing Schwab past that $10 trillion AUM mark. And keeping thinkorswim was a huge strategic win because it caters to that highly active, technically demanding trading demographic.
And the immediate ramification was just the disappearance of a major brand.
Right. The final step in that consolidation just happened. Schwab finished the account transitions and officially shut down the TD Ameritrade brand in May of 2024. That closure, it really marked the end of a competitive era.
And the expansion just keeps going. Looking ahead to November 2025, they've agreed to acquire Forge Global, which is a private shares platform, for $660 million.
And that shows they're adapting to the newest trends. There's this increasing appetite for access to private market shares, before an IPO. Schwab is just making sure they remain the comprehensive gateway to virtually every asset class for the individual investor.
A company going through such enormous structural shifts, it really needs to manage its public identity carefully. Section 5 looks at the evolution of their branding, their dramatic physical relocation, and the newest leadership succession. Let's start with marketing.
Schwab has always used branding to set itself apart from the stuffy, hyphy world of traditional Wall Street. And their most iconic campaign was probably Talk to Chuck, which launched around 2005.
Oh, I remember those ads, the distinctive animated ones by Flat Black Films. They were simple, they were memorable, and they were just everywhere. And the campaign was so effective because it cut through all the complexity of the single, approachable phrase, Talk to Chuck.
It positioned the company as an accessible friend, not some intimidating institution. And that branding really reinforced their return to that customer-first model after the whole Pottruck debacle.
But by 2013, they evolved. They switched their creative strategy and launched the Own Your Tomorrow campaign. And this shift, it wasn't just aesthetic, was it? It mirrored their strategic pivot.
Not at all. Talk to Chuck was mostly about transaction and access. Own Your Tomorrow shifted the focus to holistic financial planning, to goal setting. Schwab was moving beyond just being a cheap place to trade. They wanted to be your comprehensive wealth manager, your advisory partner.
And that focus was essential for marketing their next big thing, the intelligent portfolio service, their robo-advisor.
Exactly.
Which brings us to their dramatic structural evolution, the Great Relocation. Effective January 1st, 2021, Schwab moved its corporate headquarters from San Francisco, California, the city of its founding, to Westlake, Texas.
This was a seismic shift, both geographically and symbolically. San Francisco represents high cost, high regulation, the spirit of innovation. The move to Westlake, Texas, that symbolizes a focus on cost efficiency, a lower regulatory burden, and a more stable, centralized operating environment.
It's an analysis of corporate priorities, isn't it? As the company matured from this scrappy innovator into a $10 trillion behemoth, the need for cost optimization and operational efficiency just outweighed the need to be physically in the epicenter of disruption.
Precisely. And paralleling that physical shift is the newest leadership change. Walt Bettinger stabilized the company for 16 years, but he retired at the end of 2024.
The torch is now passed. On January 1st, 2025, Rick Wurster assumed the CEO position. It's a transition that really shows the company's commitment to internal succession planning after such a long tenure for Bettinger.
But the one true constant anchor through all of these changes, the relocations, the acquisitions, the CEO switches, it's Charles R. Schwab himself. He's maintained his continuous role as chairman since 1971. He remains the philosophical guardian, making sure that core mission stays client-focused, even as the scale has just ballooned.
We're going to transition now to Section 6, and this is the critical analysis that every well-informed investor needs. When a company gets this big $10 trillion, it inevitably has major operational failures and regulatory challenges, and we have to analyze these impartially to get the full picture.
We should start with the Yield Plus Fund disaster of 2008. This was a really severe crisis of trust because it involved a proprietary product, something sold under the Schwab banner, which always implied reliability and safety.
And during the peak volatility of the 2008 financial crisis, the Schwab Yield Plus Fund had a devastating return of negative 31.7%. Investors, including Charles Schwab himself, lost a combined $1.1 billion.
We really need to understand why this product failed so spectacularly. Despite a name that suggests yield and safety, the fund was heavily invested in much riskier assets, including huge amounts of mortgage-backed securities and corporate debt.
The very things that collapsed during the crisis.
The very things. And the contradiction is the key insight here. Schwab, the anti-Wall Street firm, sold a proprietary product that was way riskier than the average retail investor understood, and they suffered a catastrophic loss right alongside the big banks.
It had to have severely tested the trust people placed in that brand. The funds were eventually closed in 2011, but it's a powerful reminder that proprietary products, even from trusted brands, require really intense due diligence.
Absolutely. And now let's turn to what is maybe the most important controversy for any modern investor: the failure to disclose robo-advisor fees and allocations, which happened between 2015 and 2018. This really exposes the mechanics of how $0 commission trading is actually monetized.
The SEC levied a massive penalty here. In June of 2022, Schwab subsidiaries were ordered to pay $187 million to settle charges related to failing to disclose fees with their intelligent portfolio service, their robo-advisor.
And the core of the misleading claim was that Schwab advertised the service as having no hidden fees. But the SEC found this just wasn't true because of an opaque yet critical revenue mechanism known as cash drag.
Let's take a minute and detail this mechanism clearly because it's important. How exactly did Schwab profit from the cash balances, and how did that create a drag on the client's investment performance?
It works through that vertical integration we talked about. Schwab required that a certain percentage of the client's portfolio, sometimes as much as 10% or more, be held in cash. This cash was then swept into Schwab's own affiliated bank.
So it goes to their bank.
Right, and the bank would then take that cash, lend it out or invest it, and keep the substantial spread between the interest it earned and the, negligible interest it paid back to the robo-advisor client on their cash balance.
So the client's portfolio was never fully invested, and that uninvested part was generating revenue for Schwab's banking arm, not for the client. That uninvested cash acted as a drag on their overall returns, especially in a bull market.
The SEC-specific finding was that Schwab failed to adequately disclose that the primary purpose of this mandatory cash allocation was to generate significant, undisclosed revenue for Schwab. It wasn't solely based on prudent risk management. The $187 million settlement was largely based on the revenue they generated from these undisclosed cash sweeps.
This is such a crucial insight into how commission-free models work today. If a service is free, the firm has to be making a profit somewhere else. Cash drag is one mechanism. We also have to explicitly talk about the other major one that funds $0 commissions: payment for order flow, or PFOF.
PFOF. That's the revenue a brokerage like Schwab generates when it sells its customer order flow, so the stream of buy and sell orders, to a high-speed trading firm, a market maker, for execution. That market maker pays the broker for that guaranteed stream of orders.
Which is why Schwab's acquisition of its own market maker way back in 1991 was so critical. By internalizing flow or selling it to others, they can capture that spread or collect PFOF payments. These revenues, PFOF, and the cash drag from sweeps, they are the fundamental drivers that let Schwab offer $0 commissions and still maintain a massive profit margin.
Understanding the profitability of these two mechanisms is just essential for any modern investor. It proves that transparency around how your cash is managed and how your orders are routed is the new frontier of regulatory scrutiny, now that commissions are effectively gone.
So if we look at the entire sweep of Charles Schwab's history, what we see is a story defined by these powerful, almost paradoxical dualities.
On one side, you have the ultimate pioneer, the technological evangelist. They risked capital on beta, they seized the opportunity of Mayday deregulation, they pioneered 247 client access, and they consistently used technology to lower the barrier to entry for everyone.
All the way to fractional shares and $0 commissions. They successfully democratized investing.
They did. But on the other side, you see the strategic complexities and the high costs that come with becoming a $10 trillion institution. The failure of U.S. trust, the internal crisis under Pottruck, and the severe regulatory penalties from the Yield Plus disaster and the opaque robo-advisor fees.
These moments just demonstrate that scale brings systemic pressures that can sometimes erode that founding principle of absolute transparency.
So what does this all mean for you, the learner? The fact that Schwab achieved this incredible scale proves the success of deregulation and technology in massively empowering the individual investor. You have more control, and you pay fewer direct fees than any generation before you.
But the controversies we analyzed, the SEC settlements over cash drag, the reality of PFOF and the revenue model, they demonstrate that the burden of critical thinking has now shifted. You're not worrying about high commissions anymore. You now have to diligently follow the money trail. You have to ask where your cash balances are sitting and how your order flow is being monetized. The structure that allows for free trading is inherently complex.
And that leads us to our final provocative thought for you to chew on. Today's mega firms, which are now dominated by Schwab after the TD Ameritrade consolidation, they operate on a structure where profit relies heavily on monetizing client cash and selling order flow. As these giants grow even larger and continue to dominate the market, what new ethical and regulatory challenges will inevitably arise concerning the fiduciary duty they owe to clients, given that the firm's profitability is linked not just to client growth, but to the often opaque processes underlying these free services?
The market structure has changed, but the fundamental need for profit remains absolute. Thank you for joining us for the deep dive.
We'll see you next time.